Good afternoon and welcome to the Morrows Monthly update for October. Last month, headlines were dominated by the US government shutdown and the looming debt ceiling. Whilst an 11th hour agreement was reached, this was only a temporary solution and markets will again be faced by these same issues early next year. The Australian equity market moved higher by around 4% during October. Global equity performance was also quite strong across both developed and emerging markets, with the US up around 4% and Europe up 5%. Bucking this broad trend, however, were Japan and China, whose markets fell by around 1%. Global bond yields also fell during the month, as it became less likely that the US Federal Reserve was going to taper its stimulus in the short term. Commodities were mixed, with industrial metals rising, however soft commodities did fall. Gold was relatively flat and oil prices fell by around 5%. The US dollar traded within a relatively tight band against most major currencies, and during October the Aussie dollar rose by around 1% relative to the US dollar and also appreciated against the euro and the yen. US economic data was effectively put on hold until mid-month when the US government reopened. Manufacturing data came out positive, house prices rose and industrial production was higher. Whilst the unemployment rate fell to 7.2%, the number of jobs created came in significantly below expectations. In Europe, data continues to be mixed. Manufacturing expanded, consumer confidence rose slightly and industrial production was also higher. However, unemployment remains at record high levels of 12.2%. And the inflation data also came out significantly below expectations. In China, economic data continues to improve, with manufacturing and services sectors positive. Industrial production and retail sales were strong, and US GDP growth came out at 7.8% for the year ending September. In Australia, business confidence has risen to a 3-year high. Trade data beat expectations, and the unemployment rate fell from 5.8% to 5.6%. At its November meeting, the RBA left rates on hold at 2.5%. Despite the continued uncertainty over the US debt ceiling and the general lack of quality corporate earnings growth, markets have continued to push higher. We appear to be in an environment where weak economic data is viewed positively because it means that stimulus measures will remain in place for longer. There's now an expectation that the US Federal Reserve won't taper its stimulus in the short term. In this environment, we're likely to see the continued trend of money flowing out of defensive assets and into higher yielding risk assets such as equities and property. Whilst the equity markets do not look overly expensive, they're also not cheap by historical measures. Momentum is currently to the upside. However, we need to start to see corporate earnings improve and/or better than expected economic data to ensure the sustainability of the current rally. In our portfolios, we continue to focus on risk-adjusted returns as opposed to high-risk returns, and we believe that investors will be rewarded for this over the medium to long term. We thank you for your time and we look forward to talking to you again next month.